we'll get to some real world topics, perhaps, from bond market dysfunction to nervousness ahead of US CPI. There's plenty of big news. So to discuss, Paul Ashworth from Cameron Harrison joins me live via Skype. Paul, great to see you again. It's been a little while for you and I, so I'm happy to be able to have a chat. First and foremost, just a little bit of a gut test or a gut feel on how what's going on in the gilt markets may play out. Clearly, Andrew Bailey talking tough, probably trying to stem off any kind of moral hazard. But clearly, it seems that markets are still nervous about this.
I think that's right, Carl. We would generally note, in terms of the corporate debt world, that things are generally quite solid. Whether that's in Australia, the US, and for that matter in the UK, all economies that we operate in terms of strategies. But I think you do raise an interesting point in terms of financial stability. What sits there in terms of the financial system, and I think that's also true in the US as well. It doesn't get a lot of airplay, but as we know, and as the gilt leverage pension fund scenarios played out and continues to play out, it's very opaque, and there's surprises that catch the broader financial markets by surprise, and we're left with these discussions. Is it as stable as what we think it is? Well, in the UK, this has clearly shone a light on it. The Bank of England is obviously managing its way through that, but we'd also raise the question of US financial system stability as well, and what might be the surprises there.
Yeah, certainly. I mean, I suppose learn in time, perhaps with the gilt situation in the next few days when they, ostensibly pull support from the market. But I mean, more importantly, of course, and this is what we're here to talk about from a strategic point of view, we've still got yields rising, inflation expectations continue to ratchet up. We have that CPI print at the end of the week, and while central banks are net sellers of bonds at the moment, I mean, how does that impact portfolio allocation decisions, especially as it relates to trying to find some level of safety, perhaps in the bond fixed income portion of your portfolio?
Sure. Well, I suppose the key thing that we're always talking about is the assumptions as managers that we make, Carl, and the assumptions that we've got to make are those in 3 months, 6 months, 12 months out, where we think inflation will be and where we think bond markets will be. Where bond markets were last week is not where they are today. So the assumptions that were made a week ago are not holding true today. So we set forward looking over the course of the next 6 to 12 months in terms of forward strategy setting. We think bond markets will settle. We think inflation will continue to be attacked by the central banks. We think the tasks of central banks around the world are different, and that's probably the key thing that we would note, is that the task in the US we think is vastly more difficult, and that's for certain structural reasons. And in Australia, we think that that task, whilst still various rate increases we're expecting over the course of the next 6 months, we think that we'll get to a position in Australia in terms of monetary policy settling and bond rates declining. And in that respect, an asset class that we highlight at the moment is the listed property market here in Australia.
Okay. Do you want to expand a little bit on the
Sure.
the listed property market in Australia in particular? There's something appealing at the moment with the current backdrop?
There is. Well, if we're talking about equities around the world, we're invariably talking about risk of significant reductions in economic activity and impacts on earnings. We've already seen the PE effects in terms of equity markets. and we're likely to see reduction in actual earnings over the course of the next 6 to 12 months. Listed property we think is interesting, it's really with respect to industrial property, Carl, because we think there's a little bit of dislocation or arbitrage there. Certainly the cap rates are elevating, but the physical market and where values and activity is lying is very different and really at odds with where the listed market's at. With many of those trusts being 30% off, yet showing good earnings growth, both in the most recent reporting period, but really in terms of forward outlook over the next 3 to 5 years. So we think there's an arbitrage between the physical and the listed market, and that comes out at a next year a 7 and a bit % distribution yield. 2024 coming out around the 7.4, 7.5 distribution yield, and over that 1 and 2 year time frame, we do expect bond rates to moderate from these elevated levels, and we would expect good 20 to 30% increases in values. So it's a story where you've got earnings uplift, and there are not many of those over the 6 to 12 month period ahead.
So is that to say that you look through the interest rate risk associated with that? Because I suppose, again, I've certainly not got the experience myself, or perhaps even the knowledge, some would argue, but you associate real estate sector with interest rate sensitivity, interest rate rise is not good. Is it a matter that, again, you look through that, or is it in the anticipation that eventually rates will go down and their valuations will be improved by that as well?
Yeah, no, I think that's a good way of putting it. We are there to, in the way we manage capital, we're there to set it up for 12 to 15 months forward. In terms of where bond rates find themselves, where the bond futures, let's say in Australia, 10-year bond futures are pricing out maybe at around the 4.4, 4.5% level. We take the view that it won't get to that level. But yes, we're prepared to say that yes, we do think, on balance, particularly in Australia, that the yield curve will start shifting down through the course of the second half of next year, and in the meantime, that's positive for us to be holding those type of positions. Let's say with a real yield of growing real yield of 4 to 4.5%, over the course of the next 2 years.